Hey everyone, today's episode brings Josh Williams, the co-founder behind W&P, Kitchen Tools, Wild One, design-forward pet accessories, and Courant, tech-driven laptop chargers and hubs, all proudly housed under the very great umbrella. Each brand is lean, design-led, and customer-first, but collectively they unlock operational synergies through shared supply chain, marketing, and logistics. We dive into how Josh decides when to build a brand internally versus partner or acquire, what makes a product retail native and why choice of distribution channel matters across categories, and how Wild One carved out space in the pet industry with aesthetic and functional differentiation. Welcome to In the Money, an exploration of whether you can still make money in D2C and CPG. We talk to some of the most interesting $5 million to $50 million founders, operators, investors, acquirers, and lenders in the space to ultimately answer the question, is D2C and CPG still a good business? Hope you'll enjoy the show. So, Josh, you and I have both participated in one of the wildest capital markets bonanzas of the last 5 years, which is money going into e-commerce or digitally native holding companies. You are one of the surviving players. So you guys have obviously figured out something that a lot of other people haven't. Share with us what that is.
So if you look back at the arc of e-commerce holdcos or platforms, if you want to call them that, we kind of view there's two different categories there. There were aggregators, so you had the Thrazias of the world, and there were DTC holdcos. And we're kind of neither, so in the aggregator space, you saw a ton of money come into this space truly for an arbitrage. So these were people buying basically cash flows, off of products that were being sold on Amazon and arbitraging the fact that, it's super low cost to finance those acquisitions. So interest rates were super low and there wasn't a lot of capital flowing in the space. And ultimately, arbitrage reverses every time. So, in this case, it reversed and kind of the writing's on the wall for what happened with the aggregator space. So you've seen them either, go out of business, like merge and try to, make 1 + 1 = 3 work, which is really not working because the fundamentals have shifted entirely. So the aggregator space is very different from what we do. And I'll try to talk about what we do. And then the D2C holdco model was really predicated on pure play D2C for oftentimes products that ultimately couldn't be sold direct to consumer profitably anymore. This time period where they could, when acquisition costs were really low, they can no longer. What we do is we build digitally native brands, but then we distribute them omnichannel. So we're building digitally. We have digital presence for all of our brands. But then we distribute them in a what we call natively omnichannel distribution model. So we're selling them online on our sites, we're selling them on Amazon, but we're also selling them to very large retailers. And when you look at where we drive profitability and really the health of our platform and why we're still in business today, is that omnichannel mix and that retail program that we partner with very large retailers. That's the key unlock. And I think for our product types that we're selling today, that's what's making them successful.
Your brands are online, presumably .com as well as Amazon. You're also in some of the leading retail environments. Are there any interesting things that you've learned regarding making a product kind of retail native versus D2C native?
I think ultimately your product needs to perform, whether it's online in an Instagram ad or it's on a shelf. And so there's a presentation of a product that has to be correct to convince somebody to buy it. So there's a big difference between selling a product on an Instagram feed and on a website where you have a PDP that can tell the story of all the features and the benefits of the product versus when you're in store and you're on a shelf and being able to tell that same story. And I think where that begins is from the very beginning of when you're packaging a product, designing a product, the touch and feel. You've got to design it to be natively ready for that environment. And so anything that we do, we're thinking about that from day one to make sure that when it arrives in a Walmart, it's going to sell because you only have a split second to grab somebody's attention on a shelf. and you need to be looking at what's around it to make it work. So that's more of like the product and packaging side. I think for the fundamental economics of a product, that's where many D2C brands have a lot of trouble retrofitting product and economics, like unit economics for a specific product, into the formula for a large retailer. And once you start working with them, you discover that a lot of the things that worked for your direct to consumer product don't work for a retailer. And you then have to re-engineer to fit into that environment for the economics of a product. So things like product COGS or packaging have to be re-engineered. And that's a huge effort if you want to make it into a Target or a Walmart.
Cards on the table. Your tech stack is held together with duct tape and prayers. If you're a brand founder or COO juggling Shopify, your 3PL portal, 3 different inventory trackers, and yes, that one crucial Google Sheet, you know exactly what I'm talking about. Orders get lost, inventory counts are fiction, and your seamless integrations break every other Tuesday. Endless Commerce changes the game. One platform for everything. D2C, wholesale, marketplaces that works. AI-powered forecasting, real-time inventory visibility, and integrations that actually integrate. Teams like Great Jones, Food 52, and Pattern Brands already made the switch. So ready to ditch the chaos? Visit endlesscommerce.com. Mention me or In the Money when you reach out and get 3 months free. Because your ops stack should be your competitive advantage, not your biggest headache. I'm really glad that you brought up re-engineering costs into retail. Let's talk about the other side of that, which is the sell-through and the velocity. A lot of D2C brands get pretty excited when they get their first 6-figure PO. They may even get a 7-figure year one throughput, but you guys are selling 8 figures into retail, and most D2C brands haven't been able to make that jump. They invest a ton of money when they're 6 and 7 figures, ground game, trade spend. In fact, they probably overinvest to get that velocity, to get the door expansion, the SKU expansion. How have you guys traversed hey, we got the look, and then we're able to sell through consistently?
Yeah, it is tricky, especially as a challenger brand where your awareness is not at 100 yet. So you're growing, you have a new product, you have a new brand that you're introducing to people, and to do that and then sell through is very difficult. What we found is there's 2 sides to it. One is what you do and what you can influence, and the other is what the retailer can influence. So for what you can do is you can design a product that is instantly recognizable and engaging, both product and packaging, regardless of the brand awareness. So number one is create something that looks great on a shelf, like grabs people's attention. It's the same as creating a piece of content for TikTok or Instagram that is thumb stopping. We call it like aisle stopping. Like when you go down an aisle, you got to make sure that somebody goes, what is that? And stops and then grabs it off the shelf to look at like what it is. So that's number one of what you can control, is that immediate first impression is kind of like top of funnel in the aisle. And then the middle of the funnel in the aisle is like, what's on the package? Like how do you explain the product? How do you pitch it when you're not in the room and you can't control everything? So that again comes back to that first phase of product and packaging design. Now, what can you partner with a retailer on? That's the other side of the coin. And the best way to approach it is thinking about what's going to make this program successful for the buyer that is going out on a limb to give you a chance, because those buyers are beholden to sell through in that space. They've got dollars that they need to see for their budgets to keep their jobs, so what can you do in partnership with the buyers? That looks like limiting initial store count. So if they want to buy for 2,000 doors, maybe you talk to them about doing 300 to 400 to start, in their best performing regions or their best performing stores that are like the best fit for your customer base, your product, because then you can get a foothold before you accept that, multi-million-dollar PO that's going to put you out on a limb. Try testing with their best stores. You're going to learn a lot. Like when we went into Petco with our brand Wild One, we had a bunch of different formats for how we went in. We tested a lot of different formats. We found the things that worked. A bunch of stuff did not work, but some things really worked. And then you can lean into that and you can go deeper on the second or third iteration of the program so that you know what works and you're testing and iterating. It's the same as like testing and iterating on social with paid media. It just takes way longer and there's a much longer lead time to get that feedback.
To go back to holdcos, I'm curious, what have you learned about operating synergies that come from running multiple brands? Where do you centralize the portfolio? Where do you let each brand run independently?
We've tinkered with the model and really evolved it over the last several years of how we run brands. Today, we are fully centralized as a team. So all our teams work across our portfolio of brands. And that's evolved, out of really testing and seeing how you get the most out of a really high performing team. And the one area where we tend to have more specific and brand specific professionals is in the product space. So we have a portfolio of products across brands that span, electronics, food and beverage products, and pet products. You can imagine that those are very different categories and different supply chains. So we do have specialized individuals that do product because the product has to be the best for us. And, that when we think about how to develop a new product, it's very specific to that brand. And so we do have separate siloed professionals that work for that type of product development.
And do you think that the centralized model has worked for you because you have 3 brands, not 10 brands, where a lot of the other platforms or holdcos are running between 10 and 60 businesses? And so the centralized model was so chaotic?
I think that the centralized model could definitely work and is scalable for that number of brands. What I think from an outsider's perspective happened in those situations is too many too fast, to be able to digest. And in speaking with, friends and colleagues that like worked on the inside during that spree of acquisitions, I think it was drinking from a fire hose and they just couldn't process them effectively fast enough. And so it was chaotic. And I think a lot of baggage came with those acquisitions. I also think that there's a difference between building and buying. When you buy, you inherit a lot of hangover from whoever was running the business before. And on a spreadsheet, it might look like a great cash flow stream. And in practice, when you get the brand and you get under the hood, there's probably a lot of skeletons in the closet. And so when you're building, which we've only built brands to date, you get to create your own mess. You get to create your own world that you're operating in. And there's no surprises, of what you're acquiring.
I'm curious, again, credit where it's due. You guys started before the 2020 craze. Like you just mentioned, you guys have incubated brands 0 to 1. 3 brands takes a lot of discipline. How did it not end up being 15 brands?
Yeah, I think we took the approach to go fewer, bigger. We picked categories where we felt there was a macro thesis, there's a macro trend, and we were correct in the 3 that we picked. I think that the temptation to go wider was always there. We have shiny object syndrome. We love new product. We love new brands. That gets us up every day. I think it took a lot of restraint, as you said, to do that. But we were picking very big categories, and we wanted to build tentpoles within those categories. So fewer and bigger was really the method for us.
To stick with the theme of fewer and bigger, maybe even fewer, there are a number of e-commerce founders and operators, some of whom we both know and friends with, Bill D'Alessandro, a Taylor Holiday, a Sean Frank, et cetera, who started with a handful of brands, started with the portfolio theory, and they had one breakout. And today they're running one large business. Have you seen power law in your own portfolio?
Definitely. One of the strengths of a portfolio is diversification. So we also believed in that. And, in building these brands, you don't have a crystal ball of what's going to happen from a macro standpoint either. So, inevitably, there's going to be some outperformers In our case, we're seeing that with our Wild One pet brand, actually. So we have a ton of momentum with that brand. And there's a lot of exciting stuff happening. Some really big programs coming online over the next year. And so that's really been the standout for us. We obviously still running two other brands, and they're very positive as well. But there's always one that kind of rises to the top throughout a cycle like that, and we have to then manage resources internally, accordingly, to figure out how do we lean into that strength when we've got it.
If you're like most founders, supply chain is probably one of those things you just deal with because you have to. Not because you love it, and not because you're an expert. If you spend hours chasing suppliers, negotiating tiny price breaks, trying to figure out if delays were real or just another excuse, you probably want to pay attention to this next bit. Move Supply Chain is a team out of the Philippines I've been working with, and they've saved me hours I didn't know I could get back. They handle the messy stuff: sourcing, supplier vetting, negotiations, tracking, and even inventory planning. They've helped D2C brands I know lock in better MOQs, negotiate stronger supplier terms, and make smarter decisions with working capital. What do I like most? They don't give you a deck and disappear. They actually embed you with ops and fix things that are slowing you down. Now here, a bonus for listeners. They're offering a risk-free 4-week trial. You can use code INTHEMONEY to get a discounted rate if you want to test them out. Anyway, if Q4 is starting to feel a little too close for comfort, check them out. It's one less thing to deal with, one more thing you can upgrade to an expert level. Website's movesupplychain.com. That's movesupplychain.com. And just to stick with that, I've long been a believer that, or rather I should say, I've developed this belief over 15 years in D2C and consumer that in the debate of market versus founder, market wins, and that you put 10 strong operators, and the standard deviation between the 10 good operators is marginal, but you put the 10 different outcomes and the variance is very, very big. And so much of that is market dependent. I'm curious internally, I imagine that you are doing some of the similar things, if not a lot of the similar things, in terms of inserting inputs into the 3 different opportunities. Were you kind of sometimes surprise yourself of like, wow, how is it that we're doing the same thing but getting such varied results, or at least one that is outperforming so much?
Yeah, I think that a lot of success is being in the right place at the right time with the right idea. But then ultimately you have to execute against it. And I do agree there's some great operators out there, and if you put them in the right place at the right time, they're going to operate and execute against a thesis. I think in the brand space, it is a little bit more complex because you have to be, we view ourselves as brand builders. You're building something that surpasses sometimes the ones and zeros of a business. And so there is a bit of an art to it that goes beyond, I think, the right place, right time, right business model strategy. That is an X factor that I truly believe that impacts consumer brands in the space that we operate. So I think that there's some art form to it, but I agree with you. Much of what drives success is having that right macro thesis up front. So I think at the beginning, when we looked at what categories, what brands we're going to get into, we did test a lot of different theses. And we shot down 95% of those, and we didn't pursue them. We actually, when we moved into our first office, we named conference rooms after each idea that we had killed, because, and some of them were actually very good ideas, ultimately, but we killed a lot that were not. And I think that helped in ensuring that 1 to 3 of them really rose to the top out of the 20 to 30 that we really tested.
The macro benefit that Wild One has been able to gain through pet, to take the other side of that, I was catching up with a growth equity investor in consumer recently, and he was complaining that he feels like consumer trends are changing so fast, and that a lot of his portfolio companies are kind of falling into product market fit and out of product market fit, and then back into product market fit again and out again. And maybe how do you think like pets are replacing children? I appreciate that as a macro theme, but in terms of staying relevant, staying on trend, how do you think about that?
Yeah, I completely agree. Things are moving much faster than they were 10 years ago. No doubt about it. And algorithmically, there are things that are driving that. The fact that something can organically go on trend via an algorithm and reach hundreds of millions of eyes is a game changer for consumer trends. And they come and they go much faster than they did 10 years ago. I think where we believe we win is we're building much longer term brand value in, say, a Wild One brand that isn't dependent on one of those coming and going trends. Like we're not dependent on, the CMOS, trend. I mean, we're not dependent on one thing. We're dependent on the humanization of pets. And that is something that is here to stay. Like that trend is not changing. It's a generational shift, and we're investing into our brands against those generational shifts. And then our brands play with those, trends as they come up. So in the case of Wild One, we're making, really fashionable pet accessories that are the best looking and the best performing. And it's all about the style of what your dog is wearing, what you're wearing. And that brand aesthetic can evolve and should evolve with trend. And so we're building around a generational trend, but we're reactive to what's happening on TikTok for sure.
Yeah. Let's go back to, given that Wild One has broken out, is of significant scale, let's go back to learnings into retail. Breadth, in terms of number of retailers, you talked earlier about kind of starting with a tight door count before kind of expanding too quickly. Maybe share other learnings you've had with Wild One and its success in retail.
Yeah, I'd say that, big learnings include, it sounds crazy, but being clear on who's putting price stickers on your product when you set. We learned that the hard way up front. Things like that you never really think about until you start working with a retailer. And then you realize that every retailer is different. And I think that's one of the biggest learnings that I've had in the last 10 years of working, digitally, where you have a lot of software and platforms that speak to one another. They're designed within the last 5 to 10 years. So they all work together. There's API connections. Everything's standardized to some extent. And it all works, and it works pretty well. And then you get into the retail world and you realize that many of these retailers haven't updated their systems in the last 20, 30 years, and they don't work, and you have to navigate how do those pieces fit together with some of the largest POs you're ever going to get. And that's a big challenge. I think it's also an opportunity if if you're a SaaS builder out there and you're looking at, where to build. I think that there's some opportunity there of trying to improve that.
For SaaS builders, it sounds like Josh has got some ideas, so give him a call and he'll talk to you about some pain points.
Definitely.
What's been your biggest win in the last 12 months, whether it's product, retailer, channel?
So hands down, biggest win in the last 12 months is we just launched Wild One, a new collection exclusively at Walmart. So it just launched 2 weeks ago and hitting stores right now. We're in between 400 and 500 Walmart stores right now and doing really well right out the gates. It's a new product line that is beautiful. It's striking. It's got that shelf appeal. And it is really true to the Wild One DNA. So that's probably my number one.
What's maybe the biggest opportunity you see for either Wild One or Very Great in the next year and a half?
So we're really leaning into the strength with the Wild One brand. So right now, we're on track to about double the size of that brand year over year, which is really exciting through many of these retail programs that are coming online. So we're really excited about that. And we're working on some new product innovations. So we've got a couple new brands under development that I am incredibly excited about. They're in some new categories that we have not been in before, but have a ton of macro momentum behind them. And so you'll see that from us over the next 12 to 18 months too.
AI. Everyone's talking about it and you're worried you're getting left behind. Meet Rich Panel, an AI-first customer support platform that's built for one thing: making support faster, smarter, and cheaper for e-commerce brands. Something you can actually feel smarter about using. Rich Panel combines a unified inbox across email, chat, and socials, a customizable self-service portal that customers actually use, and Sidekick AI, powered by GPT-4, which learns from your past tickets to suggest on-brand replies. Does it actually work? Well, with Rich Panel's guarantee, you get guaranteed 30% cost savings when you switch from Zendesk or Gorgeous, 30% automation to reduce your ticket volume, and a no-risk guarantee that if Rich Panel doesn't deliver those results in 60 days, you get a full refund. That's why top brands like Ridge Wallet, Jones Road Beauty, and Pella Cases are already using Rich Panel to save hundreds of thousands in support costs. Time to start letting AI work for you. Head to richpanel.com and start your free trial today. Real savings, real automation, real AI that actually works. I'm sure as you're scaling, there's increased operating leverage, which at your size is incredibly exciting because there's so much more flow through to the bottom line, which brings up the question of increased efficiency, which brings up the question of AI. How are you using it personally? How is it being used at the company?
I mean, it's a tectonic shift for an organization, no doubt. And, I think that there's kind of like enterprise businessy answer to that, which is it has a huge impact on our hiring decisions. And like, as we think about how to scale, we ask the question more and more of, how can we do more with the team we have today, which is super talented, and how do we leverage AI to do that? That's number one from more of an operational standpoint. From a creative standpoint, and so I work in partnership with our creative team on the brand build side, which is where I have a ton of fun. That is where I think I see the most excitement and interesting applications of kind of generative AI and how we can now build brands very rapidly, leveraging generative AI, and we can really test stuff a lot faster. So if we have ideas and we want to see how those could come to life, we can use it as more of, again, like top of funnel creative, where we can really iterate a lot faster on ideas that we have. And then as we move ideas forward, it becomes a question of how do you leverage AI to bring those things to life in empowering very talented people to use them. So I think that there's a big focus right now internally for us of how do we empower our team with AI, versus a lot of the, I guess, the scare, conversation around, this is going to take jobs. We don't view it as replacing people. We view it as empowering them.
It's so interesting to hear you talk about AI will have impact in creatives, because so far internally, we've mostly talked about it in the first half of what you said, which is like, hey, how can we draw raw efficiency through operations or through something kind of repetitive or tactical? But on the creative side, I've even heard arguments, outside of e-commerce or outside of brands regarding anything creative, using writing perhaps as an example of like, you can get chat to do an essay given a very limited prompt, but is it going to be as good as your original thinking? And in fact, you'll end up with the worst output because now you're just editing something that didn't have the kind of global maximum result. You're just like now optimizing around kind of the median output. Yeah, I'm curious is like how you're using it from a creative standpoint. And is that a concern that we're kind of being a little bit lazy and we're just editing an okay thing to start with versus like kind of creating something that's very great?
100% a concern I have of like the blanding that already was kind of happening with brands in the digital space. They were all converging to a mean of, it felt like you were seeing the same content. If everybody does use AI to generate all of their copy, it's not going to be interesting. Like just fundamentally, I don't think that you're going to see compelling takes like a Liquid Death when Liquid Death first launched. And to have something that different and that striking is likely just not going to happen, and I think in the same way. But where I think that it becomes most interesting is leveraging AI for creative iteration to start, to use it to see like, where could I go with this? Push in different directions, because to test something to see like, what if it looked like this now takes a tiny fraction of the effort and the time that previously you needed. So now I actually think that it could empower teams to move faster and iterate faster to find even more creative things, because previously the cost to do that was so high. Like if I wanted to have our creative team come up with like a crazy take on a marketing campaign, it would take up so many hours and so many resources, it wouldn't be worth it. So that campaign or that image maybe never would have gotten made. Now the barrier, the cost is so low, we can just crank it out. Be like, okay, well, that's crazy. We would never do that. But it's really effective for generating creative output that's maybe even different than you would expect.
You mentioned earlier that you're incubating a couple of new concepts, and I know that you can't talk very much about them. Maybe we'll zoom out a little bit and talk about channel out of the gate. And what I mean by that is we had on the pod Debbie Way Mullen from Copper Cow, predominantly a retail business today, but still invests in a D2C business because she finds the data to be really useful, the connectivity to the customer to be really useful. I remember having Anna Whitman from Coefficient Capital, so that she likes to invest behind retail brands, but she likes them to start a D2C to, again, get some of that data on velocity and repurchase behavior. So given your success in retail, how do you think about launch channel for new concepts?
We're honing in on the the perfect mix right now of what that looks like. So I think in a perfect world, you do operate in all of those channels. I agree, you do need D2C as a very fast, quick turn touch point with your consumer to understand how they're buying it, what are they buying, get the actual direct connection and feedback, and then translate that into what happens in retail. So that's a must have. On the flip side, I believe that launching with a anchor retail partner that is open to that iteration is also incredibly powerful. So there's a give and take between D2C and getting that feedback and retail and getting that scale. And then how do you merge those two things together? And how do you iterate in partnership with a retailer where you do launch, you see the data that you have online, then you can bring it to the retailer and say, look, let's reset in this next quarter with this iteration because we're seeing this online. Now we can bring that in store. I think that's the virtuous cycle that we're creating with our brands, and where I think you could create that in a perfect world at launch also with future brands.
Yeah. Fascinating. Josh, as we wrap, is there anything you're looking from listeners, collaborators, talent, partnerships, capital that people might be able to help with?
I mean, you said it earlier on the retail tech side, I would love to have more conversations with people that want to disrupt that space. I think that there's a lot there. Just that's more of a personal passion project on my side, but would love to chat if anybody wants to talk about retail tech. And then beyond that, we're really focused on growth at our Wild One brand. So definitely open for collaborations and partnerships in the pet space. There's a lot of fun people doing a lot of fun things in pet right now, and definitely open for those.
Amazing. Josh, thanks so much for doing this and can't wait till next time.
Thanks so much. I appreciate it.
Why do we love Numeral? Well, here's the good, the bad, and the ugly. The good is that over 1,000 e-commerce stores just like you use them for sales tax compliance, including some pretty big brands like Ridge, Emmy, Nomad, and Graza. The bad is that none of us got into this to spend a ton of time on sales tax and admin, which is why Numeral is able to help you in 5 minutes or less get full coverage, deal with registrations, ongoing filings, and compliance. It just happens in the background. And the ugly is that not a lot of store owners know that sales tax is actually personally guaranteed. Said another way, that the states could end up coming after you personally if you're not on top of it. Even a modest $5 million store owner could have nexus in 20 or 30 states. Again, Numeral helps you stay compliant, and they even guarantee their work. That's why we love them. Go and check them out at numeralhq.com. That's numeralhq.com. What I want to tell you about today is Parker credit cards. Look, there are multiple subreddits dedicated to credit cards points hacking, and I get it. But what do entrepreneurs really want in today's market? Help managing their payback windows when acquisition starts ramping. With Parker credit cards, you get up to 90-day repayments on ad spend to help you on your cash conversion rather than having all that upfront ad spend before revenue starts coming in. Parker allows you to spend aggressively while still managing cash flow, including meta spend. So instead of hunting for best points or cashback programs, realize that the best ROI is to be able to increase your ad spend without hurting cash flow. Go and check them out. Parker credit cards at getparker.com. That's getparker.com. Parker is a financial technology company, not a bank. The Parker Commercial Credit MasterCard is issued by Patriot Bank and a member of the FDIC, pursuant to license by Credit Card International Incorporated.